Again, today's video is about earnings trades. I have done on 54 stocks between July and August. I will show you some different strategies, maturities, and especially how to proceed with future earnings trades. So, have fun. You can see all the earnings, 54 stocks I have done listed by earnings date. So I began with Netflix, followed by Tesla, Roblox, and so on. And it's not only tech stocks I followed, I did many other ones like Beyond Meat or Walmart, John Deere, and so on. For me, it was important to a summary of all earnings, especially on weekly traded options. Liquidity was for me important. So let's take a look about which strategies I have used and the maturities. So the strategies is more on the non-directional with short strangle iron condor as a protection, and directional would be a put credit, call credit, and I like most is a short call cover. 80% of my short-term trades were short-term maturities. In other words, if I trade on Monday, Tuesday, expiration would be Friday. And about 20% I just did it as a comparison to the short-term that I did the same trade more or less on 15th of September. So that's a interesting look as well. So we take a look about the biggest gainers as well as the biggest losers. Beginning with the good side is the Nvidia shares. Here I did short strangles, 5 to 10 delta neutral. I did in August and September, as well as I did short call forward at the money, August and September. So this strategy is working nicely if you have a directional trade. So I bought 100 Nvidia, just 5 minutes of closing. Let's say it was around 470, and I sold at the same time a 470 call for 25. So that was certainly nice in expecting that Nvidia will go up higher, which was the case. And I did both transaction, short call and the short strangle, which I could cover right away at the next day, around 9:30, 9:35, which really a nice profit. What is really interesting too was the NVIDIA correlation with SMH. This is the semiconductor vector semiconductor ETF fund, because this fund contains about 19% of NVIDIA shares. So whenever the NVIDIA goes up or down, this fund actually moves more or less the same. So in expecting higher earnings or better earnings, I sold put spread in a quite big quantity with the August 25 maturity. So all those put opens almost worthless. So I covered them really and get a, let's say, 80-90% profit. The other one which was doing fine was Amazon as a short strangle plus the short call covered short term. So overall, those were my biggest gainers. But I think it's interesting to see too what are my biggest losers. And you see here four companies which really the loss was quite considerable, like Upstart, like Coherent, like Dick Sporting Shop, plus Food. Well, I call it now Food Loser, but it's Food Locker. But anyway, I did a short strangle of 5 delta neutral, but this would give me a kind of range of plus 20, minus 20% would be fine. But you know, if the stock opens minus 30%, well, that is what is my risk. So this one is really a hit, and I will talk a bit later about that as well. So which strategies are the most profitable? Definitely it's the short strangle on one hand, because short strangles are always working very fine when we keep the range of this 20% plus minus, and this is certainly the case with tech blue chips. So whatever comes up in October earnings for Nvidia, Amazon, Google, Meta, and so on, this is really a good strategy. But short call covered is certainly interesting when your expectation is on higher earnings. Well, then really this is probably the best strategy if you get the funds. We have to admit too. But anyway, this is a thing which I like very much because always once you're convinced that this stock will work, then you just buy the stock and sell the call at the same time. So, how many trades were successful? Let's say I did 800 trades. That is, let's say 800 transactions, we can say, because I consider that I buy or I sell the put spread and then I buy the put spread. Or we can say differently that on the account of tested trade, I paid around $483 dollars commission. So these are actually a trade with two legs. So it's about what the broker get within this 1 month. So out of these trades, 80% were successful. So whenever I did short strangles, they were all successful. Sometimes I cover them maybe by one buck or whatever, or even I let it worthless. But what's important to see is that those 20% of losses, they were really big in a way that they took a part of my profits. And this 20% is just maybe a few trades, but this trade is really a hit. So this is where I have to work on because obviously if a stock opens 30% lower and I have a put strangle or whatever, I have a put call strangle and the put is already steep in the money, this is not really fun. And so I did in as a question, what could be done if the stock opens 30% lower? Well, the moment DKS or FL opened up, I just sold right away call options right away because it makes anyway. If the stock opens minus 30, I don't believe in a recovery right away. So what I did is just at the opening selling call options. In DKS, it was like that. That the stock opens at 110. I sold 120, 121, 122 call options right away. Expiry of August 25. So that was the best I could do uh, getting a bit money out of the call options of the premium in order to offset the put options. So this is what I would recommend to you, or whatever as an alternative to roll over the put option into next week or next month, which always you would do. But anyway, this doesn't mean that you would cover your losses because anyway, if the stock would drop further down, well, you would have more losses as well. And another interesting observation is this so-called calls skew. Whenever I check about um, shares like Amazon, Google, or whatever, Meta, even Nvidia, they all had a call skew, and this is interesting because then it really is makes sense to sell the call option because you get more money for the call option than the put option because they have a higher volatility, let's say a higher probability. It's not a rule that you can say now, well, when you have call skew, the stock will go or higher. But it's always that the expectation means more or less that the stock will bring nice earnings. Well, as I said, it's something I look at it, and it's always when I see a high skew, well, then I probably will sell options, call options, but far out of the money, as I said, with a 5 delta. But I could even do a ratio spread that I would sell more call options than put options. Market sentiment is something you should not underestimate because it happens to AMD. AMD brought more or less good earnings. The stock was about 119 pre-market, but because of the downgrading of the US Treasury, the whole market gets sour. So the stock, I think, opened at 109 at the end, and I just didn't get anything out of my trade, but 2 or 3 days later it rebounded. So this is maybe something why you should look for long-term maturities of up to 30 days than just my strategy in doing just 5 days expiration options. Do a summary of all the trades so far done because I think it's very important that I can see now what can be improved on my earnings trade. Earnings is a critical game player, we know. So know your stock and know your risk management. I just took the example of the DKS. The stock was maybe at 140, 145. I did a 120, 160 short strangle, and I get maybe $2 or $3 premium, and the stock went down to 110. So on the put side, I was 10 or $1,000 in minus. So this is exactly what you need to know your risk management. Stocks can really go down or up more than this 20 or even 25%. So even 80% of my trades were successful, while these 20% they're hitting hard. So you really need to know what you're into it when you have one or two stocks really offset all the profits you got on maybe 30 or 40 stocks. So the consequences out of it is short strangles I'm doing on only blue chip tech stocks. I mean Nvidia, Amazon, Meta, Google, they mostly don't move by 20% up and down. We had the example of Nvidia moving up in May about more than 20%. Okay, this is sometimes exceptional. But when you look now, just in the earnings season in July, the blue chips, they didn't move that much. I mean, it's nice to see Amazon up 10%, but the short strangle I did was about 20% out of money. Auto stocks with high volatility, well, I need some protection. So next time, if I would do a DKS, I would do an iron condor, knowing that my maximum loss could be maybe $500 or 5 ticks, but not that I do a short strangle on DKS or Foot Locker, whatever. And what's important, they are not tech stocks. I mean, you would say tech stocks are very high speculative. Now, it can be retail stocks, it can be everything. This is what we need to be aware of it. Market sentiment plays a role too. Don't forget that even good stocks like AMD with great earnings could open lower just because the stock market gets sour. What I do is to analyze the earnings of each stock and look for the branch correlation. So in other words, TKS and M as a retail stock did not well. So at the same day, these other retail stocks went down by 5%. Retail stock which actually didn't bring the earnings so far, they will bring it the next day. But because the whole retail sector was going down, so these stocks are going down as well. Play earnings on short-term maturity, well, you need to really act very fast after the opening, as I gave you some examples. When you do just short-term maturities of 2 or 3 days, well then, once the stock opened, right away cover your trades, either call or puts, either profit or loss, because the longer you wait, the market is always against you. So longer term maturities are always easier to handle. But as I take an example of Nvidia, I did a covered call September. So I was happy to cover it right away at the opening at about 5 when Nvidia was about 500. So I get the maximum profit out of it. Because whatever then the stock went down to 470, I would not get the same profit because it's again very important that you do the things right away after opening. Are my earnings trades, my experience I have in these earnings, I think it's real. At the end, you will may ask you, well, did I actually win or did I make some money? And I say, yes, I did my profits. I'm happy with it. But I think what was more important is what I gain out of experience. I know how I will proceed with my next earnings in October. I will be more careful in selecting short strangle on those stocks. I'm pleased with it, and other ones I need to be really careful in maybe doing directional trades or at least an direct condor in knowing my risk. Well, if you can share me some experience of your side, feel free to contact me. It's always happy to hear and to read from you. Okay, so all have a good time. Bye bye.